Hello, everyone, and welcome to From the Research Chair. This is episode 3. I'm Jason Voss, and of course, that's Michael Falk, my partner in crime. Today's subject is portfolio construction. Thanks so much for joining us. I'm going to give you a brief overview of the topics we're going to cover. This is a real expertise of Michael's in particular, though those of you who know me know I was a portfolio manager of a mutual fund for a long time, and I also have some portfolio construction secrets. What that means is I'm going to be asking Michael more questions than making statements, though I'll have some participation in this. Today's topics, top to bottom, pretty chunked up are, what is it? What is portfolio construction? What do we mean by it? Next is Michael's going to share a useful metaphor that will help illuminate portfolio construction. And this is a little bit of a sneak preview, but then in terms of description of this bullet point, finding useful bricks. I would imagine that portfolio construction is going to be compared to some sort of building activity. Then how to select only the best bricks, and then sizing. I'm guessing that's maybe the size of the house, size of the construction, and then selling or discarding bricks that have gone bad. Thanks so much for joining, everyone. Michael, say hello to everyone.
Hello, everyone.
Exactly. So, Michael, share with us your useful metaphor.
Well, I'll try. And folks who know me know I like using metaphors, if only to have a little fun. Because, folks, if we're not laughing, we're crying. So let's laugh a little. The business of investing is about finding beautiful investments, picking those stocks, those bonds, whatever your preferences are, and then grouping them together and making a portfolio. So what I think of the portfolio, if we want to have a little fun with this, think of it as a house. And the house is built from all of those different and little bricks that you've gone out and discovered. Those are your individual securities, but they have to come together to make something that is useful and beneficial to people.
Totally agree. And at the outset, at the top here, I'm going to share a little research with you about portfolio construction that shows that most investment management firms don't do such a hot job at it. And this data comes from proprietary research that Tom Howard and I did for our book, co-authored and released last year, Return to the Active Manager. And what we looked at were portfolio returns over a 15-year period and the composition of those returns. And what we found was nearly 90% of the funds, in this case it was actually 89% of funds, actually show skill at security selection. So to Michael's point, lots of us know how to identify beautiful bricks. We also found that
hold on. That bears a repetition, Jason. What percent of people find beautiful bricks?
89% of firms have positive alpha from brick selection.
So, folks, you can pick them. The question is, can you stack them? We're going to come back to that.
Yeah, and here's the stacking, the bad news on the stacking. On average, those bricks, those securities, when selected, add 381 basis points of alpha. Okay, but how does that compare to the classic story, which is the active management is a fruitless endeavor? And contrary to popular belief, it's not fees, so I'll hit fees in just a second. There is a portfolio drag. Said another way, the constructions we make out of those beautiful bricks don't look like 14-year-old people putting Legos together. They look like 3-year-olds putting Lego together. And the drag there is 271 basis points. And some of the things that contribute to it are asset bloat portfolios that are too large, closet indexing, and a lack of conviction, which we're going to be addressing here. And then 139 basis points lost due to fees. Hence, you get the classic result that most active managers do not add alpha. In addition, on that conviction bit, we also looked at the alpha added by the top 10 holdings, 610 basis points by the top 10, positions 11 through 20, 230 basis points. So this is a very valuable conversation. Michael, do we find when we do our embedding work with folks that most firms are doing portfolio construction well?
No. Now, I needed to punctuate that for fun, but the truth is, and Jason's got that wonderful data to support it, professionals in our industry are good at ferreting out good ideas. They pick good bricks, but they don't put them together really well. And they seem to always pick some that are left over in a pile after a beautiful house has been built. You don't need that many bricks. I'm using this metaphor for a reason. You're going to remember it better. And for some of you, you can see the top of my t-shirt. I'm going to move my camera a little bit because this is going to bear a lot of our dialogue today. So pay attention. Do you see the words on my shirt? Do simple better. We are going to come back to that because portfolio construction does not have to be a maniacal, mathematical, well, let's not go there just yet. Stay tuned.
So I neglected to mention in our data, a fascinating finding is actually that the folks that add alpha, the ones who actually do the best job and net of fees, net of portfolio drag or portfolio construction or deconstruction, poor construction, they actually charge higher fees and not lower fees. And we thought that was a fascinating result, and it suggests that you can get away with charging more fees if in fact you deliver the goods. So Michael, finding useful bricks, do you have anything that you want to add there other than the fact that the industry does a good job of it?
Well, yeah, and one of the things that Jason and I discover all the time when we work with all the investment managers we work with is as they're hunting for good bricks, it's amazing how quickly they do a couple of things, let's just call them suboptimally. Number one, they quickly hone in on the bricks they want to do deep understanding. What's the quality of this brick? What's the density of this material? What is it made out of? I'm extending the metaphor too far. All right. They find bricks they want to do more work with, and they quickly discard many bricks. So it's so interesting. We ask them, how do they make the decision on the discards? They're like, well, it doesn't fit, or it didn't seem right, or it didn't attract me. So they're using interesting powers of screens and intuition to say, no, yes. But when it comes to their yeses, they start digging to find out, is this something I want to own? As they're digging, they're not trusting their intuition. They're focusing more on what they think they can see in front of them. And that's so interesting to me. Oh, and by the way, the more you dig to get to a yes, confirmation bias, you're becoming more in love with that security the deeper you do your research. So that's just on the bricks. We haven't even built the house yet.
Yeah, and I'll add that one of the this little off topic, but it's in alignment with what you're saying, Michael, that we find in the embedding work is that a lot of organizations suffer from analysis paralysis. And it's the problem of data. In fact, it's ironic. I'm probably going to write my next blog post this coming week on MBAs have ruined the world or something like that. MBAs are a cancer destroying capitalism, something like that.
Wow, and Heath says I'm negative.
Yeah, right, exactly. And the reason I say that is, we're trained, those of us who have an MBA, to manage data. And I've even heard people say, if it can't be measured, then it can't be managed. The problem with that, of course, is that investing is a prospective activity, not a retroactive activity. And so if the decisions are entirely based on assessing the data and ever finer slices, it tends to be a waste of time because how the future unfolds is unknowable. So what you're looking for, and this is now back on topic, are things that have a higher probability of success than failure. And the data shows it's a lower probability of success to do portfolio construction, but ding, 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 there is a way to do it. There is light at the end of the tunnel. Is it too soon to transition, Michael, to
Well, no, let me just ask a hypothetical. I just want to ask a hypothetical to our listeners. Some of you have children. maybe not all of you. So those who don't, just play along for a moment. For those of you who have children and have more than one, maybe two, maybe three, four, I don't know, more than one. Do you love your children differently from one another? Or do you love them all the same? I know you can't admit, don't do this, don't go there. But this is a principle we're about to embark on. When you find all of those lovely bricks, I ask you, you like them all for different reasons, hopefully all valid reasons, but do you have any idea how the rest of the world is going to appreciate those bricks the way that you do tomorrow, or the next day, or the next day after that? What I mean to say is we know nothing in terms of what the return will be of those securities that we buy. We have an expectation, but we don't know what it's going to be. So why not buy a whole bunch of good ones and put them in your portfolio, and don't bias towards any single one of them? Yes, I use that word specifically. The moment you do active sizing, I like this one better than this one, better than this one. Now you're making individual bets in terms of which is going to perform better tomorrow. Since we know nothing about tomorrow, we have an expectation. Well, how close is the expectation to reality? We don't know. You unbias the portfolio by investing at initial cost each of those desirable securities equally. Yes, I just said equal weight.
Dun, dun, dun.
So let me tell you a little bit more about equal weight, and then I'll turn it to Jason.
But before you go forward, let me make one quick point to amplify something you said, Michael. When I was a PM, I always thought, because it's a future discounting activity, investing, it's difficult enough to identify those quality bricks. I thought I had value add there. In terms of the sizing, the weighting, and the magnitude of the direction of the market, alias the performance of those bricks, I thought, wow, I'm just compounding my difficulty here. And so the way I portfolio sized, probably in retrospect, was a drain of value, but I did not delude myself into thinking that I had some mathematical certainty about optimization or what the proper weights would be for something. Anyway, back on topic. That it can be summarized that what I was trying to communicate is predicting two things is harder than predicting one thing.
Yeah, and here's the point. We're not telling all of you to go equal weight. Let me be really clear about that. What we are saying is the logic behind it is inescapable. Since we don't know what the future is going to bring, you want to debias all of those wonderful securities that you have discovered and put them in the portfolio equally. The point that I'm making is, between Jason and I, we have little short of 24 independent academic research papers and studies that say, good luck beating equal weight. Now, that doesn't mean that some of you, and I have met some people who are actually quite good at making their bets, their active sizing. So what we suggest to people is build a tracking portfolio, fictional. Use your existing securities, equal weight all of them, and see over 1, 2, 3 years, start to learn, how is your betting working? Maybe is your betting not working? And start to learn whether or not the academic research, which is so strong, actually can support you and earn you higher returns.
Yeah, and to amend or append to what Michael has just said, the academic research tends to favor rebalancing on a periodic basis. The best results that we're able to extract from the academic literature says monthly rebalancing works best. Michael, would you like me to quote the data, or I'm just going to do the EdHex study because I think it's got the most clear results?
Yeah, you share one study and I'm going to have fun sharing another one. We're just going to share 2 of the 24, and then we're going to move on to another topic or expand.
Yeah, and I'll mention a couple others just in passing. One data point that's interesting from more than one, but one in detail I'll discuss. So this was published by EdHec in 2012, and it's entitled "Why Does an Equal Weighted Portfolio Outperform Value and Price Weighted Portfolios?" So EdHec looked at 4 decades worth of returns from February of 1967 through December 2009. They looked at various time periods within there, so it wasn't a selection bias based on the time frame. And then they took a random subset of 100 stocks from the S&P 500 during that time period and created randomly 1,000 portfolios. So all of these results I'm about to quote are the averages of this. So equal weight beat price weighted and value weighted by a number of criteria. The first is total mean return, which for Michael and I is our favorite way to look at these problems, as well as the 4-factor alpha model, which is Fama and French's model. It outperformed based on Sharpe ratio and certainty equivalent return, which is where you essentially say, hey, I have a minimum return I must earn, and I'm willing to pay the gap for certainty. And the basis point outperformance is fairly large. So for example, on the total mean return, it delivered equal weight 175 basis points relative to 60 bips from the value and 67 from the price weighted. In addition,
Wait, there's more.
Yes, there's more. One of the reasons I've quoted this study instead of some of the other ones that Michael and I know about is because they included transaction costs quite explicitly. So this is net of 50 basis points transactions costs. And in addition, they sought to break down what are the sources of the value add. And what they found is there's a higher beta return to market effect, size effect, and value factors. In addition, there's a higher alpha effect as well, or return from alpha, and it has almost exclusively to do with the monthly rebalancing. One quick amendment there, another study done by Fabozzi and another researcher who I'm forgetting at the moment, they found a similar result where the rebalancing tended to be the alpha that was the reuptake. In addition to the beta benefits, better beta, you also got the alpha from rebalancing. They sought to explain, was there anything else? 85% of the value add from equal weight, they said, was from rebalancing. Michael.
So I'm going to take that forward instead of going into another study, because we can share these with you offline. It's perfectly fine to do that. For those who hear rebalancing monthly and cringe because of what you invest in, the liquidity or the expenses of that, don't cringe. I want to decringe you. There is another route you can go other than monthly rebalancing. And I don't want to go too far into detail because it's a custom professional technique that we use with our clients as an alternative to monthly rebalancing. So let me just give you 2 tips. Number 1, there is an alternative. And number 2, the alternative may actually work better in today's day and age based upon the seemingly continued lack of competition. You've all heard of the concept of winner take all in economic circles and what's happening around the world with some businesses. Right. We don't know the durability, but we know the direction has been towards that for a number of years. And I mean like a decade or 2. Well, the point I'm making is there's a way to equal weight and to leverage into that potential. That's a deeper dialogue that really needs to take place with each team based upon what they own. But I'll rest it there. I will say there are 2 clients that I have had the pleasure of working with over the years that says, Michael, equal weight. What if we do more than 1? I said, well, that wouldn't be equal weight. And they're like, no. What if we do 2 different sizes and that we're limited to just those 2 sizes? Maybe it's 3% and 1.5%, or 4 and 2 in terms of position size. I'm using simple numbers, all right? I said, folks, it's your portfolio. But if you're going to do that, I want you to give me a rationale that would support bigger or smaller that the team will not vary from, so that it could become inculcated as a process. And in both cases, what both teams did they went with the lower liquidity as the smaller size. And so they did make a narrative. And quite candidly, they were more comfortable doing it that way. I've had one manager I've worked with who I brought up this topic, and this was a few years back. This is before Jason and I started having the pleasure of working together. And I brought up this topic, and the PM said, yeah, we know. I said, what do you mean you know? Oh, we've done the research ourselves. Equal weight beats our active sizing. I said, fantastic. I said, but you're not equal weighting, you're active sizing. Why are you doing it? This is when the conversation got really interesting. He said, because our clients wouldn't buy it. I said, are you serious? Have you asked your clients? So you have found a method to actually generate greater returns, better risk-adjusted returns for your clients, and you're saying they wouldn't pay you for it. He was adamant and said, no, they wouldn't. The conversation ended there, but I will tell you, I've had myriad, wonderful, entertaining dialogues about this simple concept. Folks, I'm giving you a proposal. You can throw out your optimizers.
Yeah, and to that.
By the way, they don't work anyway. It's a separate topic.
Well, sort of separate. I was about to bring it back into context. Some of the academic research, which I didn't quote, they looked at some of the classic, alternatives. For example, Markowitz and mean-variance portfolio construction on mean variance with optimizers, so on and so forth. And they feature in some of these 20 plus studies that Michael and I are talking about.
Okay, hold on. If we're bringing Markowitz into this dialogue, so for some of you who don't know, Harry Markowitz, Nobel laureate, father of modern portfolio theory. Love it, hate it, or somewhere in between, I don't care. Here's my point. Modern portfolio theory was about two things: diversification and allocation. Diversification, buy different types of securities and put them in your portfolio. Allocation, sizing. And he used mean variance optimization to give him the sizes based upon forecasts. All right? All right, stop there. He did an interview in the I don't know if it was 1980s or 1990s, forgive me, with Jason Zweig for Money Magazine. And Jason Zweig asked him, Dr. Markowitz, how have you allocated your own money? He goes, I'm 50% in stocks and 50% in bonds. And Jason then continued and said, well, is that what your math showed based upon your forecasts? He goes, no, I didn't use my math. I didn't mean variance optimized. It's real simple, Jason. I don't want to regret owning the wrong asset. So 50-50. Dr. Markowitz, for his own personal money, was an equal weighter.
So the other thing I have to add to the conversation, I'm envious of Michael's t-shirt, of course, because he's got something that communicates the thing. However, I'm inspired by my audiophile headphones here. If anybody knows Little Walter, Michael, a Chicago blues artist, harmonica player, he has a song called Mellow Down Easy. And our advice, Michael's and mine, when we work with teams, and especially PMs who this begs the question, and it can be threatening to PMs, what's my job if in fact I'm at equal weighting? Mellow down easy. There's still a role for portfolio management. It doesn't go away because you equal weight. Michael, do you want to move off of sizing and go into our next topic?
Yeah, let's talk a little bit about selling. And while some of you are thinking, that's cheating, Michael, that is not a portfolio construction topic. And I will say, au contraire, because you spend so much time falling in love with the securities that you ultimately buy and put into your portfolio. And by the way, don't love your securities. They don't love you. Okay, so you've spent so much time doing this, and then you've equal weighted. You are loath to take those securities that are underperforming, disappointing you, taking up almost in all of your mind share because they are behaving very badly. And you just don't know what to do with them. Set them free. If you really loved them, set them free. Here's the point. Jason gave you the statistics. This industry can pick good securities. The data shows this industry can buy pretty well. The data shows this industry is not sizing well, so stop it, just equal weight. Okay, the data shows that this industry is horrible at selling. That's because you're too attached. You fell in love with these securities. And Neil Sedaka told us that breaking up is hard to do. I used to say, some of you don't even know the reference because of you're overseas or you're too young to know that reference. I'm so sorry. John smiled, so he's of age like me and he understands the reference. All right, here's the point. You can buy well. Sizing and selling are the two nasty twins of portfolio construction. You have to deal with the nasty twins. When it comes to selling, people do not spend time on selling like they do on buying. Almost every behavioral bias that can hurt you when it comes to investing lives in the sell discipline. Lives in the sell discipline. So if you can sell well, which is essentially repositioning your portfolio, because almost always, if you're taking something out, you've got two choices. Do you add something in, so that's a new equal weight maybe, or do you rebalance the holdings that are in the portfolio already to a different equal weight because you've got fewer holdings? Those are your two fundamental choices. The reason why selling comes into the portfolio construction conversation is because the result of selling will impact your portfolio construction one way or another. Research seems to indicate if you can just sell well, the average portfolio manager can add over 100 basis points to their annual performance. Would you like an extra 100 bips? Just curious.
No, I want 101.
Oh, you greedy bastard.
No, you stated it was, would you like at least 100 bips?
Go ahead, Jason.
No, go ahead, Michael.
So we want to essentially square the circle, right? You do research, you do idea generation or research. Different firms have those in one order or another. They can be inverted. You buy stuff, you size it, you sell it. Then the real question is, do you learn from all of those experiences? That's a topic for another day. Systematic, continuous improvement built into your investment processes. Maybe a topic you'll like to hear about in the future, don't know. But if you buy well, then portfolio construction is about sizing and selling well enough to keep all of the wonderful decisions you made on the buys.
So, Michael, we're right at the bottom of the hour in every time zone I know of, except for India, where we're at the top of the hour. Let's switch to Q&A. Folks, you can use the chat function to ask questions. However, we received a question from one of the folks on the podcast today via email, even before we sat down today to talk with you. And so I'm going to read that question off. If you see me talking to my cell phone or looking at my cell phone, it's because I'm reading his question. He says, I have a couple of questions. Many firms do a good job of explaining the characteristics of the companies in which they invest. By comparison, the description of the portfolio management process tends to be relatively vague. I would say even opaque, honestly, even to the folks making the decisions. Even for firms such as, I'm not going to name the firm, which provide thematic percentage mixes of their equity holdings, it is often not easy to connect individual holdings to themes. Question 1. Do you know of any outstanding examples of non-quant portfolio construction transparency? Michael.
Yes, I do. So to appreciate you using the word themes, I want to come back to that for just a moment. If you have a thematic portfolio, then the question is, how many themes are you pursuing? That begs the question, how many themes can you pursue well? And then how you're positioning each theme. I'll give you an example. Jason and I have worked with several managers that like to be sector neutral to an index. All right, well, if you're sector neutral, then the equal weight has to come within the securities in those sectors, if you were to follow this logic, which actually works quite well. But to Paul's question, how many themes, and Paul, maybe you can use the chat box and give us a little more detail. And the question is are they good at balancing the themes, right? Let me give you a simplistic example. Let's say you had a manager who said, we ascribe to each of the E, the S, and the G in ESG. We actually leverage all three themes. Then my question is, do you have data to show which of the three themes is better or worse in terms of your performance? And how are you weighting those themes? Are you good at weighting those themes? Folks, I care deeply about data. Another word for that would be evidence. And the evidence is when we're talking about strategies, do portfolio managers share this? And on average, they don't share it, Paul. I've seen how the sausage is made in many, many, many places. Some think deeply about it. They don't talk about it a lot within their pitch book, as an example, a sales pitch. But the question always remains. People talk about how well they pick securities. They don't talk about how well they allocate those securities, because historically, they have done their active sizing or allocation based upon their conviction. And when people use the word conviction with me, I ask, do you know whether or not you should be convicted? How are you measuring your conviction over time? Data, data, data. Let's find out what you're really good at and do more of that, and stop doing the stuff that's hurting your performance and hurting your clients.
Yeah, in answer to your question, Paul, I know very few firms that have a formal sizing discipline. It's exactly as Michael said, it's based upon conviction. And the data is available, but most firms do not collect data on that type of material. PMs escape the purview of it. And by the way, it's not just PMs that escape. This is also, if this story isn't just about active investment managers who are doing security selection, it's also about private wealth managers. It's also about asset allocators. There's not a lot of evidence that we have found that shows that that's a worthwhile endeavor, but a huge proportion of assets under management in the industry is migrating towards things like fund of funds or ETFs or all kinds of crazy stuff where there's not evidence that there's asset allocation, and there's certainly not transparency into how weights are chosen. Next question, let me pull up my email once more. Paul also asked, do you think that in reality portfolio construction is much less disciplined than security selection beyond remaining within certain /factor exposure limits and liquidity related constraints? Michael.
I do, Paul, because can we just be really candid with each other? It's not sexy. Portfolio security selection and research to an extent, that's the sexy part of this business. Just put another log on the fire. We have a good fire burning. Let me just get another log and put it on the fire. So portfolio construction has escaped the purview of much of the industry, but more to the point, Paul, and for all of you, and I do hope you share more questions and get into this dialogue. So much of the industry is asset allocation, and I don't mean within a portfolio. I mean across portfolios, private wealth, financial planners, advisors, brokers, whatever labels you want to use. They're putting together a beautiful puzzle picture with different asset classes, the pieces of the puzzle. And how they essentially put those asset classes together is the very same topic that we're talking about as it relates to securities within a portfolio. So sizing, positioning is a universal topic. And I went through the CFA program. Jason went through the CFA program. Many of you may have, or alternative programs wherever you're located. Don't know. There's not a lot of conversation or education in this area, which I think is the big reason it's overlooked. It's a strange code to crack. And if you can crack it as simply as with some variation of equal weight or some strategy along those, well, that's like one page in one academic text. you probably learned it and forgot it.
Yeah, I'm gonna jump in here, Michael, only because my comments in answer to this question are somewhat related to where you're going. I don't know that we're in the state that we are because securities analysis is the sexier part. I mean, it's fun. I certainly enjoyed that part because it has a long duration, right? It takes more time than, going with conviction level, which is a simple check-in. I think one of the things, and I said it earlier, one of the reasons as a PM that I avoided the portfolio construction problem using things like mean variance, frontiers, or optimizers, or whatever, is I recognize that predicting the future twice makes it twice as hard. But said another way, what is it about security selection that does have probabilistic content? And I think the probabilistic content there is we have a lot of transparency and certainty around high quality businesses and their likelihood to repeat their performance based on the classic fundamental factors like moats, like an excellent management team, like a killer suite of products, scale, good information systems. Walmart's case, they drive a hard bargain with their suppliers. There are all kinds of things that add value, and there are many more levers for businesses to pull that lead to a higher probability of their continued success. And that's one of the reasons why I think that most of the data that I read at the top shows the value add in security selection. Additionally, as individuals, most of us on this podcast today have spent time in a capitalistic society, and we're used to interacting as customers in a very intimate way with these businesses, or we can investigate them. So we are almost, from the time that we know what money is, starting to evaluate our customer experience, our interactions with businesses. And so we have vast knowledge about what constitutes a great business. We have much less knowledge about how to weight a portfolio, which is a much different problem. And then final point here, there just aren't that many tools available. The research that we were reading about equal weight outperforming, there are any number of arcane topics, mathematically derived topics and portfolio construction techniques suggested that have failed to beat statistically significantly, or even beat it all absolutely, equal weight. So that's my answer, is that a lot of firms, the art of it is in the security selection, because I think there's higher probability there than there is in the portfolio construction.
Jason, I think that's a wonderful point to add. It's easier to either understand or think you understand a single business than an entire asset class or segment of the economy. To some extent, that's an arguable point, but there's a logic there, and that makes sense.
Yeah, and Michael, you saying that, I think that the portfolio construction process, even if it had better tools, my prediction would be that, like, I have pals that are deep into quant, right? And even they're fluent in the equations and the execution of equations and knowing when to invoke an equation, but that doesn't mean they understand why it works. And I think when we look at a business, we can understand why it works. And so attribution and identification a priori, what's going to succeed, is much easier. You talk to a mathematician, I want them to explain real world what a fourth moment really is.
Playing with their maths.
Playing with their maths.
Folks, we're not supposed to be playing. This is a business.
Well, we have one other question from Paul, and I'm surprised that nobody's asked questions over in the chat box. Please feed those in. Final question from Paul. Do you think these claims about macro forecasting are often exaggerated and or self-deception? Michael.
Macro forecasting. Well, let's begin with understanding something that is a very, very human condition. Narratives. We are comforted by narratives because it helps us make sense of maybe a single piece of data. It's context, it's logic. Narratives are memorable. Narratives can be sexy. Narratives are our entire global news cycle. It's almost all narratives. So global macro forecasting is, let me move you into the golf world for my metaphor here. And most of you know this, even if you're not golfers. You drive for show, you putt for dough. Strive for show, putt for dough. Macro is a narrative show. Security selection execution is putting for dough. I'm not saying people can't do macro forecasting, but it is another order level higher from what Jason said. If we can understand securities, maybe we do that more than we understand sectors. Maybe we do that more than we understand asset classes. Macro, the number of different individual stories, seen and unseen, heard and unheard, that make one macro narrative. So Paul, to answer your questions succinctly, it's great for presentations. It's great for client conversations. Whether it's self-delusion, I don't need to go there. What I can tell you is it's a lot more driving for show than putting for dough.
Yeah, and Paul, my response is one of my pieces of advice that I render to any person who's entering the business, certainly to the research analysts that used to work for me, was job one as an investor is to know who you are, and especially know what your true talents are relative to how they're going to encounter the big, huge, gigantic, unbelievably complex world that we all live in. And so in answer to, can people do macro forecasting well? I'm sure there are people who do it well. But the beautiful and terrifying thing about our business is that we are measured based on our success to execute based on our mandates. So if they claim they do macro forecasting well, let's look at the data. And if they show that they can, I will believe it. Otherwise, I think it probably is a reflection of where they feel best about themselves that drives their interest in macro forecasting. Sorry, but that's a behavioral factor. That was Paul's final question. I see no more in the chat. Michael, do you want to pause for?
Yeah, Paul has sent additional. I love this. Paul is having a dialogue with us. I don't know what the rest of you are thinking. So
he sent it to you directly. Paul, did he send it to you? Then you need to read the question out loud because nobody else can see it.
I know.
Okay, all right. Just making sure.
Here I go.
All right. Yeah.
Paul, so you believe that firms that say they don't do macro forecasting actually don't, and don't consider how it impacts individual company 3-5 year results. Listen, the moment you invest in a security, you're making a forecast. You're making it based upon that security. Now, if you invest in a bunch of securities in a similar sector, similar region, similar country, you are making a form of a macro bet by definition because you're overweighting that small segment. So I can call that, Paul, I can refer to that as a macro bet, but that would be an intentional bet. And macro forecasting, well, if you do any kind of discounting to get to a present value estimate, you're in the macro forecasting business because you're forecasting interest rates to some extent. So Paul, what I'm saying is we can't escape the macro. The question is, to what extent are macro aspects or decisions a part of your portfolio construction process? And can we measure those decisions? That's the key, because if we can measure those decisions, and there's always a way, then we can determine to what extent you're using macro, to what extent you are either skilled or unskilled at using macro. And we can create kind of a dashboard for how you do this and maybe where you would better spend your time in the future, if different than what you're doing now.
Yeah, and I'll answer your question somewhat differently. Paul, I don't think that's probably necessarily the context you were asking with your question. I think your question may have been, and I may be wrong, more are the firms that say they're doing macro forecasting, that is an edge. Is it true? Again, I don't necessarily know. What I can comment on, and way back in the day, approaching 30 years ago, I was a pension consultant. And, so I got to see these pitches. And as a part of our due diligence process, one of our questions was, are you doing what you say you're doing? Now, in my post-PM career, both as CFA Institute content director, as well as a consultant with Focus and Michael, We do. That's one of the things that's part of our due diligence process is what's in the marketing literature and are you actually doing it? And I think the answer, Michael, correct me if I'm wrong, probably 95% of firms that represent something in their pitch decks are in fact doing that. Whether they're doing that well or not, there's an entirely different issue.
It's a different question, but you raised something I just want to give away to our group here today. When you receive questions from a consultant, from a potential investor, right? And, you know, they go through, there's the usual tail of the tape questions. My favorite question, which was really quite difficult for them to answer, just for giggles, be prepared for this. If you ever have to come up with somebody who's as maniacal as me, okay, what did you invest in that performed exceptionally well that you're likely never to repeat again? So when I actually did due diligence on portfolios, I want to see the tail of the tape of the various performances from your individual picks. If I take your best performer out and I take the worst performer out, pretend I'm an Olympic judge and I'm taking the high and the low scores out, what does it do to your performance? So these are types of things, these are ways to kind of test and torture to find out, are you consistently good? I care deeply about portfolio managers' batting average. How often do they pick a winner? I care about their slugging percentage. What's the average win from those picks? From those two pieces of data, I can understand a great deal about a manager. And if you ask me how many managers actually know those two statistics about themselves, way too few.
Yeah, it's chronic. That's usually among the handful of issues we see recurring at the firms we do our embedding work with is poor data. So have you received another question from Paul, Michael?
I have not. I have no more questions showing.
No, nor do I. I would say let's wait 20 seconds here while they come in, and while we're polling for the questions, I could do the preamble to the exit.
Go for it.
Does that sound good? All right, so our next from the research chair is on the 6th of August at the same time, noon Eastern. It's always on a Thursday, every other Thursday. And the subject is going to be conducting management interviews. For those of you not in the know, that's something I am probably one of the handful of global experts on. I've spent over a decade studying it because it's, in my opinion, one of the places that alpha leaches out the door or alpha opportunity never occurs, because it's done ad hoc without any sort of professionalism brought to it. And I've conducted scientific research with criminal justice professionals on things like lie detection techniques. Punchline, sneak preview, it's not body language. Body language doesn't work. Most people think if they're doing that they've got their edge in the management interview, but it's bunk, it's hokum, it's a hoax. Anyway, I will be discussing some of the techniques, not just lie detection, on our next podcast. Michael, we have no questions that I can see.
Jason, are we going to do our pet peeves?
Oh, God, yes, I insisted we do it, and I almost forgot. All right, so a feature that we're going to do because we think it's fun, maybe nobody else will think it's fun, and that could become your pet peeve. Michael and I are going to do a segment, completely non-investment related, thing that irritates us that probably doesn't irritate anybody else. Michael, what irritates you but may not irritate anybody else?
What irritates, well, listen, it's hard to pick just one. Can we all be honest with each other? The thing that irritates me greatly is people are not buying my book. And you know what? Since they're not buying it, they probably do not care. So that is my number one nominee right now for things that irritate me and probably don't irritate anybody else.
And shameless plug, right?
And a shameless plug. Hey, it took me to our third podcast to actually make a plug.
Exactly. Well, true. I've plugged a couple times. Anyway, the thing that irritates me, perhaps irritates nobody else, is the count of the millennial. When we call the end of the millennium or the end of the decade, irritates me to no end, and it has for decades. Folks, this is the end of the 2010s this year. Or the 20-teens rather. It's not the beginning of the 2020s. Just start counting. You go 1, 2, 3, 4, 5, 6, 7, 9, 10. And at the completion, we roll over to the new digit. We don't start counting 0 through 9. 2020 is the end of the 20 teens and whatever that decade is called, not the aughts, but the teens. That endlessly irritates me. I see it all the time. I see it in macro forecasts from sell-side banks. I see it on the nightly news. The 2020s has proven so far to be tough because it's COVID. It's like, no, it's the end of the decade, not the beginning. But alas, nobody believes me. Anyway, with that, thanks so much for joining us today, and we'll see you in 2 weeks.
Thank you all. Hope you
Bye.
come back for the next episode.
Yep, bye.